Hello to January 5th. We have another big winner, MRK, MRK, 185% profit. And because it's in 080 money, it went right to the winner circle. So let's go look at the numbers. And there it is, MRK. We bought it at $1, got out at 285. So let's do the numbers. So 285 minus $1. And remember that options are in hundreds, so you multiply this by 100, so that's 185. And we minus the 100 from the 285 gross, giving us a 185 net, divided by the 100 that it cost as a percentage, and the return is, voila, 185. There we are. Okay, so now that we have that in the coffers, and because it didn't owe us any money, let's go to the charts and look at the chart right there. There's the chart. And you can see this was a open market scan that I did back here on March 14th. Let's bring in the data box so that we can see it. And right in there on the 14th, it qualified, and that got me set up, and it went into the, and it went a little bit sideways for a while. Man, it didn't get worrisome because it never got down to my visual stop out. And then also remember that we are employing the EPS. What is EPS? EPS is entry price stop. And that comes from the Market Wizard books. Many traders in the Market Wizard books use EPS, or actually go to the one first ratio. So I prefer the EPS because it gives it a little bit more room. But the bottom line is that I reduced my risk of 1 unit to less than 1 unit. So whatever this percentage might be as a loss in the options, it's 1 unit risk for 3 unit return. So the thing was, once this price has cleared the entry price, which I call cleared the gantry, like a rocket ship. So one of Elon Musk's SpaceX Falcon 9 takes off, clears the gantry, and then we move the stop from here to the EPS. That's the EPS stop, entry price stop. Then we wait it out. Now, price did close above the first ratio. I did not do that. I will not go to the first ratio unless I see price above the second ratio, because price has a habit of coming back and retesting. And sure enough, had we done the first ratio, we would have been stopped out here. And we would not have taken, and then the rules of this particular strategy called the CB5 would not have entered in here at all. It would have picked it up today after the big move. But no, we entered down here. We waited it out. We had an expiration date. This vertical red line is the options expiration date, the monthly for January, and my drawings. So here is the angle of inclination that I have drawn out. And then there is my 3-to-1 ratio, which is the horizontal. And then the vertical line is my interception point. I was anticipating that this would reach this point based on this line of attack by the 30th of December. It didn't make it. But I had all this time left to get there. Now, I know this goes against conventional wisdom. You're not supposed to buy options less than 30 days unless you're selling the option because you want time the key to work in your favor. Well, guess what? Options are cheaper. Yeah, that's the risk. And because I am using the delta theory, and the delta theory is I'm trying to get as many contracts as possible to shorten the move that I need to get to that third ratio, which is my exit point. And that's what I did. We had, so yeah, let's go over the data movements in a moment. So the point was that is what the anticipation was, but it happened here. Now look what happened. The price opened, shot up, and then fell back. The beauty of it is that it touched my exit point. My exit point was at 79.74. And our high was 79.81. And there it is. So you can look over here in the data box. Keep your eye over here. There it is right there. The high was 79.81, and we were out at 79.75 actually. 79.75. I rounded down to the next penny up. The bottom line is we got out with 185%. Okay, so let's go over the data, and then what would be the anticipation of going forward? Well, first of all, because MRK did not owe me any money, it's in the winner circle. Therefore, it will not be up for contention again unless the scanner finds it again with opportunity. So here we go. We entered the 12 on 12.14. It was a CB5 candle. That's what candle will be. That we're risking one candle. We're not risking the swing low. We're not risking the intermediate price channel. We're not risking the low end of the 2 standard deviation. Open market, which means that it did not owe me anything anyhow. And ROI 100 is at ROI 100. We go to last bar low. I was going to be going to last bar low here. I was looking at it this morning. So okay, it'd be last bar low. But during the time that I checked it early this morning and we got to closing, it popped up and cleared my exit point. The entry was a stochastics of 41, which is 41, and the RSI 14 was at 36. This is known as the sweet spot. For beginning traders who are using indicators, the sweet spot of entries of the stochastics and the MACD working together, the RSI, not the MACD I'll come in a minute, is 40-60. 40-60. On the MACD, I like to see that the histogram is going in the positive direction, and that the KDY lines are the blue line, which is I think is the K line, the K or the D line, it's a K line. The K line crosses the D line, which means that there's strong momentum to the upside. So those are the indicator of that was the data. It was 19 million shares traded on that day for that move here on this on the setup candle, and the entry was a 74.05, which was the top of that candle with a little bit of to the next 0 or 5. We got 4 contracts. Expiration of January, which is the vertical line, at 77.5 was the strike price with a delta 26. We estimated the cost of 103. We got filled actually at $1, which was very good. The allocation is 9.2 to the account. The target was 2.4. Now 2.4. Now, when I don't have a position that doesn't owe me any money, then I want 10% of the current day capital. So if my building capital on this was about $4,000 on this particular day, so I want 10% return. So I shoot for a $400 return. And that's what then my calculation comes out that I need to reach 2.14 for the exit on the option to get that 10% on capital. The target was 78.33, which of course was way over, was just between the second and third ratio. And we anticipated to be there in 2 hours based on the standard ATR and the standard. And we were supposed to get to the third ratio in 4 days, which means that in 4 days with this ATR here, we should have reached this by the 4th day, which of course nothing's perfect. As you can see, the action going flatline after we got in. Coming down, I projected a 198 loss and a 48% loss if this had gone all the way down to the original exit. That's why I go to EPS. I want to cut this potential loss smaller. Now, sometimes it will happen. Price will come up, stay hovering around the EPS, and then out. It happens. But look at the return. I mean, I got 1.80. I got 185% return. So the result is if I lose this, if this is results in a 50% loss on the option, and I make up 185, I am now 3.3 quarters ahead in the ratio of risking $1 to make 3. The EPS stop would move to 74.05 on the 20th of December. And then we had our stop, we had our out at 79.75, as you witness here. So there, the conclusion is we had a winner's circle exit of 185% in 22 days, $185, 4 contracts, $740 to return, minus $6 for the fees, meaning a net of $734 to the winner's circle because it didn't owe me any money. And that is today's report for MRK at 185% return in 22 days. And I catch you guys tomorrow, or maybe the next time when we have another celebration of win, win, win. And with that, take care and thank you very much for stopping by.